Hello friends, welcome to all, I hope you are well. Today I will show you how to create a trading tactic with moving averages in a 5-minute period. What needs to be paid attention to, I will show them, my friends. Also, you know that moving averages generate a lot of buy and sell signals because they follow the price chart. But how do we know if these buy signals or sell signals are a real buy signal or a real sell signal? How do we confirm this? What should we pay attention to? I'll show you these guys. Before moving on to the video, if you feel to ask questions about the training video, my Telegram address is available in the explanation section of the video. You can come and ask me any question you want. I try to help you as much as I can. Now, friends, a 5-minute period is open before me. First, I add the moving averages. I will add EMA friends. I'm adding 2 moving averages. I'm making the value of one of these 8 friends. Let's change the color and make the line a little thicker. I make the value of the other EMA 23. That's it. As you can see, friends, an image like this is formed. When we look at it now, it seems easy, friends. But here are some things we should pay attention to. We always say that a buy signal occurs when the short moving average crosses the long moving average upwards. How a buy-sell signal is formed with these, let me show them first. Then to confirm these in order to understand whether the buy signal produced by the indicator is real or not, I'm going to show you guys by getting support from another indicator. Now this black moving average is 8-day moving average, the other orange one is 23-day moving average. When these two intersect on the upside, that is, when the 8-day moving average and the 23-day moving average cross on the upside, it creates a buy condition, friends. Now I specifically say, we use the 8-day moving average as a trailing stop. So we use it like this, as long as prices continue above the 8-day moving average, we use it as a trailing stop. When the price closes below the moving average like this, then we will stop, friends. But here we have to be careful. If 2 moving averages, i.e. 8 and 23-day moving averages, are close to each other. If they are moving close to each other like this. If it goes close to each other and parallel to each other like this. Here we take the 23-day moving average as a stop. Another thing, friends. For example, you enter the trade here and price moves above the 8-day moving average. And here the candle touches the 23-day moving average. It doesn't close below, but let's assume it closes below. You stop here because the candle touches and closes below, and you stop here. To enter the purchase again, friends, you can re-enter the process with the help of the indicator that I will show you shortly. So it goes like this 23-day moving average works as support. You are already dealing with support here. If this is a true buy signal, when you enter the trade from the support. So when you trade according to the 23-day moving average. If the price rises above the 8-day moving average again, you can continue using the moving average as a trailing stop. Now, friends, let me go back a bit and show you the fake buys and sells. It's not a fake over there because it doesn't intersect. For example, let's see, friends, here is. When we look, the price intersects here and we say that the 8-day moving average has crossed. We go directly to the transaction. When we enter the transaction, we see that the signal here is fake. Here comes a fall. It goes down again, then goes up again. So it is inevitable for us to suffer here, friends. If we just go by moving averages, we will lose 100% here, friends. Because we do not know on what basis it gives a buy signal. As I said, moving averages are very volatile because they follow the price chart, friends. So let's be careful. Now we need to use an indicator so that we can understand whether this is fake or not. This will be the indicator we call Fisher transform. How do we understand this? Let me tell you first. I have given a lot of information about Fisher in other training videos and trading videos. If you watch those videos, you will know completely about Fisher. Now friends, here, as you can see, the moving average has given us a buy signal. And it intersects here. Let's assume we enter the trade when it crosses here, then it gives a sell signal again. Now look, friends, at the intersection, Fisher is already in a sell area at the place I described. And Fisher already intersected before. Fisher's buy signal is here, while the moving average gives a buy signal here. When Fisher touches the top line in the tutorial videos I told you before, it creates a sell condition. We do this, let's say the moving average crosses, we'll see where the Fisher transform intersects. It is important for us where the Fisher transform intersects. When we look now, yes, the moving average has crossed here, but the Fisher transform is in sell zone. We may not fall for the fake here, friends. Now, another point, as I just told you. You can use 8-day moving average as a trailing stop. You can also use the 23-day moving average as support. Now look here, the gaps are narrow. So here you don't need to stop directly when the price drops below the 8-day moving average. You have already traded here, you exit here. When the gaps are tight, you can use here and here as support. Or if you're a good trader, you'll sell upon the price touches anyway. When the price goes above the moving average again, you buy, you have profit again, friends. But I hope you understand what I mean logically. Set the 8-day moving average as a stop order as long as the gaps are open. Stop when the price closes below the 8-day moving average. If the breaks are close to each other, it goes down to support, as you can see here. It goes above the 8-day moving average from the support again. Let's go back a little further on our chart and find a different fake signal. For example, there is an intersection here, as you can see. What we always say in the first candle, let this candle be the confirmation candle. It crosses at this candle is the confirming candle, and we look. The moving average has indeed crossed to the upside. But now, when we look at the Fisher transform here, while moving average gives a buy signal. The Fisher transform signaled buy here and the moving average intersects here. The price is already close to the sell zone. Here what we can do, for example. Let's say it intersects in the middle and not here, it intersects in the middle, like this one over there. There is a very good example here, let me explain there. Fisher transform intersects in the middle. If it intersects in the middle, there will be no problem, friends. Now when we look at here, the moving average intersects, as you can see. The Fisher transform also intersects again in the middle and produces a buy signal. With this you get the confirmation, we get the confirmation that the buy signal is not real with the Fisher transform. We check, we don't look at Fisher transform again. After that we use our moving average. And we watch the price above the 8-day moving average. As you can already see, the 23-day moving average is moving away from the price. The 8-day moving average allows us to use it as a trailing stop, folks. Again, as you can see, let's go back a little further. If I can find other examples, I'll show them. For example, here friends. There's an intersection there, as you can see. We can't do anything here anyway. We can't do anything about the price over there. As you can see, this is where the price already intersects. Here we can follow a path like this. Moving averages crossed. We also see a buy signal in Fisher. Prices in the moving average. Unless the price goes below the 23-day moving average, we can follow the price, friends, but first, let's not enter the transaction directly in this case. When can we enter the transaction? We can buy when prices rise above the 8-day moving average. When you encounter a situation like this, Fisher gives a buy signal above, but the moving average is just intersecting, as you can see. And here is a big buy condition. As I said, in positions like this, you don't get into trade here, you think it works as support here. After closing above the price, you can protect your position by using the 8-day moving average as a trailing stop. Let's go back a bit, friends. For example, one more example. The moving average intersects here, giving a buy signal here, and as you can see, Fisher transform is already in the sell zone. This is how we can get rid of the fake here, friends. For example, this region, friends, intersects here. It gives a buy signal here, as you can see, a fake signal. It intersects here. If we check the fake signal here in the same way with Fisher transform, we can save our transactions from fake signals, that is, fake buy signals. Let's go back a little further. You will be a good trader, guys. If you are trading in a 5-minute period, it would be better if your profit margin is around 0.5%. If you profit between 0.50, 0.20, 0.3%, you will get the margin of those fakes. You can also get those big sums above by following them with trailing stop loss. The important thing here is when entering the trade in the 5-minute period, do not set your profit margin high, friends. So as you can see, it produces a buy signal here. Price is above the 8-day moving average. It can be sold when you get a profit of 0.20, 0.25% there. That's how I do it, guys. I usually go this way because it's not clear what will happen in a 5-minute period. In a moment, the graph may reverse, my friends. Because we trade with moving averages and generally scalp transactions are done on moving averages. That's why we need to know how true and false the buy and sell signals it produces are. And now I'm giving you an example, friends. You will set up this strategy, but how will you set an alarm on TradingView? Let me show you, friends. Now we create a buy condition when the 8-day moving average crosses the 23-day moving average on the upside. So we want it to sound an alarm when the 8-day moving average crosses the 23-day moving average on the upside. The black trend line here is the 8-day moving average, guys. I click on the 8-day moving average. I right-click on it. As you can see, EMA appears, it says Add Alarm, EMA 8 says Add Alarm. I click on Add Alarm, the condition will be executed via EMA 8. I don't choose to cross, friends, or every intersection will sound an alarm. When crossing up, regard the intersection like this. When two moving averages overlap or move horizontally, friends, it will constantly sound the alarm. Let's pay attention to it. I choose cross up. So when EMA 8 intersects with EMA 23 upwards, alarm sounds for me, friends. We can do it in one go, we can do it for each candle. We can also choose that the alarm will sound whenever the price touches and every condition is met. It will be better for you, friends, if you choose this as every candle close. You will also receive guaranteed signals, and then retroactive alarms will sound. You say that in this parity, in this graph, my alarm rings and say let me check it. Here you create your alarm. I have now set an alarm. We can see the alarm here. As you can see, friends, here are exponential moving averages. I'm closing this for now. You can check it this way, guys. When your alarm goes off, on the other hand, you confirm it with Fisher transform. You check if that signal is really a buy signal. This is how you deal with it, guys. As much as possible, you stay away from losses in fake buy signals, false buy signals. In the same way, since the indicator I described is a moving average, you can use this strategy in short positions, in positions where you expect a downward decline. That's all I want to say about this subject. I hope this training video is helpful to you. Take care of yourself, goodbye, I wish you good luck, see you soon.